All right. Thank you, everyone, for joining Capital Conversations, episode 3. We're really happy to have you. Myself, Faya of Leaving a Legacy Investments. We have Breanna of Soul Investors and Cindy of Emerald Peak Solutions. And we're here to kind of give you a brief introduction into real estate. So we will get started with Brianna giving us a few terms to start with.
Hi guys. So I'm just going to go over very basic key terms regarding multifamily real estate, and then Cindy and Faya are going to dig in a little bit more. So what exactly is multifamily real estate? That's what we're concentrating on. So what does that mean? Obviously, it means multiple residential units. Typically, it's 5 or more, owned and managed as a single investment. You can own multifamily being like a duplex or a fourplex, however, that falls typically under the residential side. So 5 or more is what is classified as multifamily. And we focus on this side because it provides a little bit more of stable income, obviously scalability, and reduces the risk compared to multiple single family homes. And it's a great wealth building potential. So you have more rental income, property appreciation, and then obviously the tax benefits. So that's just a little brief overview of multifamily. And then obviously when we're purchasing multifamily, something that we need to focus on is a term called syndication. What is syndication? Syndication is a structure where multiple investors pool their capital together to acquire and manage large real estate properties under the leadership typically of a sponsor. So this gives smaller investors access to large high value deals. And I think it was Judy, you're like, I want to get into this, but how? Well, the syndication's a great way. That's a great way for you to get inserted into multifamily real estate. So this gives passive investors the ability to contribute their capital and then not have to manage it. They earn passive income on that. The sponsor, also known as the general partner, oversees the acquisition, the management, and eventually the sale of it. So what is a sponsor? Sponsor, maybe also known as a general partner, is the person who is leading that company or that syndication and is responsible for managing that investment and executing the business plan for that particular investment. So their role is in acquiring properties, securing the financing, implementing a value add strategy, handling the operations. General partners often invest their own money to align with these interests and with their investors as well. And then they kind of earn a compensation through fees, profit splits, and then asset appreciation. A limited partner is somebody who is typically a passive investor. Then they provide the capital in exchange for the equity and potential profits, but they don't have the responsibilities of managing the partner. They just get to enjoy the cash flow, the appreciation, the tax benefits while minimizing their risk. Their liabilities are typically limited to their initial investment, and then they received preferred returns before a sponsor ever takes any of those returns. Okay, so what is equity and what is debt? Equity essentially is ownership interest in the property, and debt is just the borrowed capital, typically the mortgage used to finance the property. Equity grows as the property appreciates and the loan is paid down. Leverage allows investors to buy large properties and amplifies the returns, but it also has a little bit of risk, and syndications typically combine debt and equity to maximize returns. Am I going too fast? Does anybody have any questions so far? No? Everybody's good? Okay. Oh, go ahead. No? A cap rate. What is a cap rate? So a cap rate is a metric that is used to estimate the expected return on an investment. And that is typically calculated from the net operating income divided by the purchase price. A lower cap rate suggests lower risk and a higher property value. A higher cap rate may indicate maybe there's some higher risk, but maybe there's some better returns. And we use cap rates to compare properties and market trends. An NOI, as I just kind of mentioned before in the cap rate definition, is essentially just the income a property generates after deducting the operating expenses, but before accounting for the debt service. So essentially, NOI is the revenue, so the rents and the fees minus the operating expenses, which could include maintenance, management, insurance, etc., more things. And this is just a really good indicator for property performance and valuation. And NOI can be increased through maybe increasing rents or doing some expense reduction to boost the property's value. A cash-on-cash return measures the annual return on the actual cash invested. So it is calculated as the cash flow divided by the initial investment. This helps investors assess short-term cash flow performance. It's ideal for comparing different real estate deals. And a higher cash-on-cash return indicates a stronger cash-generating investment, typically. Something that we like to I guess, concentrate it on is value add strategies. So a value add strategy is essentially just how are we going to improve a property's value? What can we do to improve its value? By making renovations? Can we enhance the operations? Can we increase rents? Can we add a dog park? Can we get people to pay for laundry? Different ways. So that's what a value add strategy is. This could also mean maybe just upgrading some units, adding, like I said, some various amenities. And essentially, it's just to maximize the properties of value. And then this in turn leads to obviously higher investor returns. A preferred return. So a preferred return is what the limited partners would receive before the sponsor takes their share of the profits. So this protects the passive investors by ensuring they receive a set return before the sponsor ever receives any profits. It's typically structured between 6 and 8% annually. And after this return is met, additional profits are then split according to whatever the syndication agreement is. A waterfall structure is just a framework for distributing profits between the limited partners and the sponsor. And this kind of falls in tiers. So this just ensures, again, like the LPs receive their preferred return first. Any additional profits are split between the sponsors and LP. And then this just kind of aligns interest. So sponsors earn more when properties perform well. What is asset management? Asset management is essentially just the ongoing management or oversight of the property to make sure we are maximizing its value and profitability. So this could include, tenant maintenance, making sure we're taking care of expense control, monitoring the financials, having a skilled asset manager. It just ensures the NOI's growth and an optimal exit timing and exit strategy. And it just helps to activate management or to have management to execute this value add strategy effectively. And then the exit strategy is the planned method for liquidating the investment to generate returns for investors. So when are we exiting? How are we exiting? What does our business plan look like to exit? So this could include things like selling the property, refinancing to return capital, or it could mean a long-term hold for cash flow. And every exit strategy is a little bit different. And then the very last thing is a 1031 exchange. So this is essentially just a tax deferral strategy. This allows investors to reinvest proceeds from a property sale of a like-kind property without paying any immediate capital gains. So this is just used to compound wealth by deferring taxes, essentially, and it helps investors transition into better performing properties, larger and better performing. So those are our key terms, our important real estate terms of multifamily. And I'm going to pass it over to Cindy, who will talk about single family versus multifamily.
Exactly. So single family rentals versus multifamily rentals. If you go to the next slide. So this is an example of the acquisition for the purchase, financing, and hold of a single family residence. I actually chose these numbers because this is my property. And I think it's a great example to show you all. So I bought a property in 2020, for $319,000. I had to put 25% down because it's an income property. So when you do that, you have to put 25. So that was $79,750. Okay, remember that number. So I got this awesome mortgage rate of 3.375. Do I want to get rid of that? Not really, but just wait, Judy. Judy's shaking her head. No. No, you don't want to get rid of that. Well, that's what I thought. That's what I thought 2 years ago. But then I joined multifamily. So my monthly mortgage payment is $1,383. My HOA, sadly, is $519. It's in Highlands Ranch, so what do you expect, right? Colorado people know what I'm talking about. Rental income, $298 per month. Not a lot. And that is before expenses. This year alone, I had to go over there and do some stuff. I don't know if you guys saw my video. I tried to upload it, but I couldn't, about my tenant who needed me to come over and replace the thermostat. This guy builds rockets for a living. And I asked him, did you change the batteries? Oh yeah, I changed the batteries. I go to Home Depot, I buy a new thermostat, I go over there, and I'm like, maybe I'll just try some new batteries in the old one. Tried some new batteries in the old one. Guess what? Yep, it was fine. So I spent 2 or 3 hours, doing this. I had to go over there one time on a Sunday night to have the dryer vent blown out because the clothes dryer kept saying, it kept stopping because it was too hot. And this is a condo on the 4th floor, and the vent was blocked. So I had to go over there. That was the only time the guy could come. It's 4 o'clock on a Sunday night. So anyway, I'm making $298 a month, and I'm showing my rocket scientist tenant how to put in batteries. So anyway, my net income before the expenses, I think I said this, is $3,576. So you can go on to the next slide. So this is a multifamily. I don't own this property. This is not an example of something that I own. But if you were to buy a 4-unit property for $800,000 and put down your 25% of $200,000 at a 6% interest rate, it's not even the greatest rate, right? Your monthly mortgage payment would be $4,800. And then after your expenses, your net operating income, your NOI, would most likely be about $2,000. Go to the next slide. So this, I hope you guys can see this. And I don't think I have a way. Can you guys see my cursor?
No, because I'm sharing the slide.
Okay. So yeah, that's what I was hoping. So this right here is a spreadsheet. This is what I wish I knew before I bought my condo. Because usually what we do in multifamily, if you guys can see down here, I keep trying to use my cursor, but on the third to the last line, it says equity multiple. And it says 2.02. So an equity multiple, it means that you're going to multiply your money by that much. So that means if I had 75,000, I would have 150 when this project is done. I bought my property in 2020. Okay. And I have mostly doubled my money, but in the meantime, I've been through 3 tenants. I tried to sell it last fall. It didn't sell. And, it just hasn't been as easy as I anticipated. And I still own it. I couldn't sell it. So I'm hoping here in the next couple months that I will be able to sell it. So anyway, I wanted to put this on here because it shows you beginning member capital is 75,000 on year 1 there. Bia, will you be able to point to that, or whoever's doing the slides?
Tell me again which one you want.
Beginning member capital year 1 is 75,000. Well, in the first year, you're only going to make $1,594 if you see net return on investment there. But if you go all the way to the side over there, where it says 17,114, that's the income you make for the 5 years, as if it was rental income. Well, I made about 17,000 with my little $296 minus expenses. Okay. But if you go to, so in year one, you're going to make $1,594. On year two, what we most likely do in year two is we refinance at year two when this is a multifamily syndication project. And so what they end up doing is returning a large portion of your member capital. So in year two, they return 54,097 plus you've got that 5,041 that year. And when I say returns like that, when you do a multifamily property and you're in a syndication, they send you quarterly returns. Just ACH, it goes directly into your account. So because you're getting back a large portion of your investment there on year two, the next couple years, it's not as great, but you still have 3,500 one year, 3,400 the next year. But what happens in year five is you have the cash flow of 3,555 plus you get back your return of member capital. Trying to see here is 20,000 because that's the difference between 75 and 54,097. And they sell it. So profits from refinance or sale are 59,308. So if you take that number, 75, obviously times 2.02, it's about 150,000. So over 5 years, you've made 100. You've made 75, but you've doubled your money, so you have 150,000. And I bring this example because if I had known 5 years ago, I would have done this. And I would have taken my 75,000 that I put into my condo, and I wouldn't have had all these costs. I wouldn't have had to go over there and change leases. The first people I put in there almost had to evict. So anyway, that's kind of why I brought this sample on. Syndications, it varies. Sometimes you can do 25, sometimes you can do 50. Every syndication is a little bit different, and they have a minimum that you can invest. So I hope everybody kind of understood that. And if you have questions, we can definitely take them at the end. If you can go to the next slide, please. And so the other thing is, Breanna had all those definitions, and then part of the reason we had those is so that you guys can understand this, which most people understand the valuation of a single family rental property. It's got several factors. You've got your location, the size of the house, the square footage, is it updated or not? And then when an appraiser looks at it, he says, okay, well, in the last 3 to 6 months, what's sold, right? So if the house next door is the same floor plan as mine, and it sold for 500,000, well, mine is probably going to sell for 500,000 as well. So, and that's kind of what it says on the bottom. So go to the next slide, please. So in multifamily valuation, it's very different. And I think my stuff got mixed up because I had technical issues on my end. And that's okay. You guys will understand. But on a multifamily property, that is not the way they value it, okay? They use the net operating income, the NOI, and the cap rate to figure out what the value of a property is. So the net operating income, as Breanna already said, is the gross rental income minus the operating expenses like the debt, the management, that type of thing. And then the cap rate, she had a little bit different definition because it's kind of a broad thing. It's kind of a tough number to pin down. So you determine the cap rate by recent sales of similar multifamily properties, but you also do it with the net operating income, and you divide the purchase price to get your cap rate. So this is kind of opposite here. So this is supposed to be an example. If a multifamily generates $100,000 in net operating income and the cap rate is 6%, 8%, then the value of the property is going to be $1,666,667. So that's kind of how you get the cap rate. I mean, the value of the property. So it's just the better the net operating income is, the better the value. So if my neighbor next door is only making $3,000 a month on her rental, but I'm bringing in $8,000 a month, I can sell my property for a lot more as a multifamily. I'm just using that as an example, than my neighbor next door who's only bringing in $3,000. Does that make sense to everybody? Yeah? I see some nods. Thank you. So they also sometimes, and I don't want to say that they just focus on this, but when they're valuing a property, obviously you're going to look at the comps of recent sales per the door. When we talk about multifamily doors, we say how many doors does it have and how much is the price per door. So, but they do look at rental markets. They see what the property down the street, how much it's renting for. They look at the classes. There's different classes, A, B, C, D, and there's an F. None of us really want to be in an F property. I was like, no. So, I hope that makes sense. The last couple of things talk about, you look at vacancy rates, the condition, and the potential growth. One of the things that Breanna talked about is what we focus on when we buy properties is value add. Some people like to buy a property that's just like gorgeous and just buy it, they're making money, and it'll slowly go up in value. But if you buy a value add property, you can really increase the rents more by upgrading the units and then making the rents higher. So that's how you increase the value of a multifamily. All right, go on to the next slide, please. And really, that's it. I'm just saying thank you. This is my information. The girls were supposed to add theirs, but we kind of ran out of time. So, I think most people who signed up today know how to reach the person here that they signed up with. And then Faya, I believe you're going to go on to tell us a little bit more about single family versus multifamily. Am I correct?
Correct. Last
All
but
right.
not least, benefits and risks of multifamily investment. So just broadly, real estate investment, of course, involves purchasing property to generate income, typically through rental income or appreciation, which is the increase of value over time, or sometimes both, depending on the property that you invest in. It is one of the most common ways for individuals and companies to build wealth over time. It's one of the more stable investments as well, which is one of the reasons why, although I do have stocks and other investments, I put a little more energy into real estate investing. It's a bit less volatile, especially now with things like Bitcoin and crypto and all of this other stuff. Real estate is definitely less volatile investment than any of those options. The key benefits of investing is a potential for passive income. For me, that is huge because I work a lot in my 9 to 5, and I know a lot of people get into real estate and other business ventures to not have a 9 to 5. I'm not that person. I do enjoy my job. I'm not leaving until it's time for me to retire, but I do need additional streams of income to ensure that when it's time for me to retire, I do not have to do another thing if I choose not to, which is where real estate investment comes along. So passive income, long-term capital gains, all benefits of real estate investment. And just like crypto and everything else, benefits and risks to real estate investment as well. So if I could move on, here we go. Some of the benefits of real estate investing. Income generation. So again, rental properties can provide steady passive income. Again, huge for me because I do not have time for tenants. I do not have time to worry about trash pickup. I don't have time for calls because a pipe burst or any of those things. I just need money rolling in from my investment and to be a part of a team that's going to manage all of the rest of those things. I just need passive income. And I'm able to get that through real estate investing. Appreciation, again, over time, it is just the value of the property that increases. I know Cindy mentioned, like if her neighbor sells their place for X amount, it'll have an effect or impact on her property. Same deal with appreciation. Sometimes gentrification, things like that, the rates go up in the area. Your property that you may have had will go up tremendously. So that's another benefit, especially when you do your homework and you kind of settle into an area that is up and coming, but not there yet. That way you can grab a property at a lower rate, and just kind of sit on it until the area increases, and you can see a good profit off of it that way. Leverage property, you can leverage. You can leverage it to borrow money to finance additional property purchases or to invest in additional syndication efforts and things like that. So you can do more with less by owning property, just using the profits and the gains off of the real estate that you already have, or are a limited partner, general partner on to invest in additional properties. There are also tax benefits, deductions on mortgage interest, property taxes, depreciation, and other expenses that'll decrease your taxable income. That is always helpful. Tax time is coming up, and I'm sure everyone is looking for any kind of tax break that they can possibly find. I definitely am. So you can also hedge against inflation. So property values and rents often rise with inflation. So real estate is a good way to preserve your purchasing power, right? Because again, when everything else rises, the rates of your property is going to go ahead and rise right along with it. Now, again, with everything else, there are risks, right? So risk of real estate investments are the market risk. Again, it could increase, but it could also decrease. So fluctuation due to economic conditions, interest rates, regional trends, things of that nature, will have an effect on your investment. Liquidity risk. There are other investments like stocks, crypto, things like that, that are a little more liquid than real estate. It's a bit of a process to get money out of real estate, unlike some of the other investments where you can immediately liquidate them if you need quick cash for something. So it's always something to consider when you are going into real estate investment. Like, you need to have a plan. Is it a short-term investment? Is it a long-term investment? Do you have expectations that you're going to turn these profits and be able to just pull money out like at will? For me, my real estate investments are long-term investments, so I am not worried about the liquidity of it for the most part. If there is a time that comes that I am getting a quarterly return that is significant, I will use that to invest in another property, but I'm not consistently looking at the investments that I have as a way to pull money out kind of at will. So that's definitely something to consider when you are investing in real estate. Maintenance and management. Maintenance, ongoing maintenance can be expensive depending on where you purchase property. If there are like floods and storms and all of those things that are inherent in that area, the insurance is sky high. There's a lot of work to be done on the back end to figure these things out ahead of time when you make a decision of where you want to invest, because these can be costly. Insurance in areas where there are a lot of floods sometimes is difficult to get, or the rates are super high, and it almost defeats the purpose of you trying to profit off of the investment. So that can definitely be a risk that you take depending on what you're looking at. The tenant risk. So there's always a tenant risk, whether it's single family, multifamily. The difference is if you have a single family property and your tenant moves out or doesn't pay rent, you don't have other tenants to buffer, right, for the amount of money that you're not getting off of that one tenant. If you have a 15 unit property, right, and you price it so that you can have a few units vacant, if you're having trouble with the tenant, you're not financially impacted the way you would be with the single family unit. So there is still a risk, right? You still need to fill that property as much as you can. You still want to make as much money as you can off of it, but there's always a risk with tenants, with just having problematic tenants. I have been blessed with a fantastic tenant and I'm grateful. I do not want to roll the dice, and I honestly don't really do any single family units anymore for that reason. Industrial real estate properties, which is different, right? Like what we on this call do is like multifamily, but there's always industrial real estate for places like storage, manufacturing, and things like that. Those are also going to have a risk, even though there are not like unit tenants that are in there. Financing risk. Real estate is purchased with a mortgage. So again, if you can't make the mortgage, you risk foreclosure. A little more riskier with single units, because if you have a tenant that pulls out, you have other things going on, you can't afford to make up that payment, you can't pay the mortgage, then you are in risk of being in foreclosure. So these again are all things to consider when looking into investing into real estate. How do you get started? Again, rewards, fantastic. Risks are real, and they're also there. So the best thing you can do for yourself is educate yourself. Webinars like this, to get as much information as you can. You can get education on your own. The Googles are free. There are a lot of groups and networks around that you can be a part of to help educate yourself on all the areas of real estate, how things work before you jump into it head first, and kind of learn by mistakes. You can learn by other people's mistakes by networking a bit and getting a bit more education for yourself. Determining your strategy. You have to determine, again, what is your goal? Is it a short-term strategy? Is it a long-term strategy, right? Do you need something that's turning a consistent profit right now? Like maybe you do have a single family unit, right? And you're getting rent where you get whatever amount over the mortgage per month, and you need that consistent cash flow. Then that's the type of investment that you would be looking into. Or like for me, I'm just wanting a multiple stream of income, setting up money for retirement. It's long term. I'm good with multifamily. I'm good with hotels. I'm good with syndications. I'm good with things that is going to produce maybe 2.5 times my investment in 5 years down the road that I'll probably use to invest in something else. So you just have to know for yourself what you're in it for, so you can determine a strategy before you start. Network and network some more. I think that is the biggest thing. I heard someone earlier say just not knowing how to shift their mind and change their mind and get into it. I think I went back and forth with real estate investment for a long time. I had individual units, but that was based on, I live in a condo, I moved from the condo into a single family, so now I'm renting the condo, and then I move and then I'm renting. So it wasn't an actual investment strategy. It was life happens, and I just took advantage of the opportunities that was there. By networking, getting into a group of like-minded individuals with the same goals, people who have like a lot more experience than I do in this industry, has helped me to understand the industry better, get with a team of people that we can help each other and work off of each other's strengths. Going at it alone, especially if you're looking at multifamily and hotels, it's not impossible, but it's very, very, very difficult. Networking is key. It's how you make relationships with brokers and agents so that you can get properties, maybe off-market properties, get good deals on properties. It's just how you navigate the industry as a whole, honestly. Set a budget and set a realistic budget about what you can and cannot afford to invest to start out with. And then again, plan. So, I have X amount to invest in now, but it's going to make me this amount in this amount of time. And I can use, right, the gains from this investment to invest in something else. Set a realistic budget and also explore your options for financing the investment. If you have properties and you do refinance, you can take money out to invest in another property. If you have things like 401ks and TSPs and things like that, you're able to leverage some of those funds. depending on your situation, and use those for investments, especially if like you're not going to retire for 10, 15, whatever amount of years. That money is just sitting there to some extent. What the growth on the money where it is versus the growth on the money that it will make for you in an investment could help you make the decision as to whether or not it's worth it to do that. But again, set a budget so that you don't overextend yourself and you know what you're getting into ahead of time. Lastly, I will say build your team and build your brand. It goes along with networking for me, right? Build your team. You need to be, my opinion, not the law. You need to be with a team of people that you trust, people that you work well with. You don't want a lot of contention in your group when you're trying to evaluate properties, when you're trying to close deals and things like that. You want to make sure everyone is on the same page and you're working well together. Luckily, I have Breanna and Cindy, and also have Todd with his misspelled last name, who is amazing at analyzing properties, which is helpful. So again, just kind of build to everyone's strength. Sometimes you have somebody on your team and it's based on location. Like if you're in, I don't know, Ohio and you have a property in New York, don't do it in New York. The rates are insane. I'm from New York and I love it, but don't do it. You're not boots on the ground in New York, right? So if you have someone there or closer that can get there when you need to, they might add value to the team that you're forming to invest in these properties. So things like that are important to consider. Having a team gives you a greater perspective, right? More things to think of. They have different sets of experiences in different regions. Collectively, you guys will be just like a powerhouse, a wealth of information, and be able to close on a lot of deals, do all the things that you want to do with your real estate investments that it's a lot harder to do on your own. So that's all I have for you today. We don't want to overwhelm everyone with information, and we do want to get into the conversation part. So does anyone have any questions?
Someone's got to have something.
I was going to say, everybody's quiet. Because we'll keep talking. We just want to, we will keep talking. We just wanted to open it up and, for questions, comments, concerns. Again, keep in mind the three of us, honestly, Todd as well. I don't know where he went. Oh, he's there. Todd as well. He's a big part of this group and helping us get things going. We started this because all of us came in at different levels with a different set of experience and education in real estate. And we have different but similar reasons why we're doing it, right? Like to break generational curses, help build a legacy, build wealth, and things like that for your family and generations to come. Like I said, to retire and not have to do anything but lift my hand for my next drink on the beach. I need monies for that. Need the money.
Right.
So,
yeah.
We all came in different spaces, and we realized that for myself, had I learned the things that I learned now with this group of people and with networking in real estate, I could be so much further. So it was our opportunity to help other people who are in our position, but then other folks who are a lot younger to give them a better head start than we had, right? And then there are people who are further along than us, closer to retirement, closer to not wanting to do anything, and it's beneficial to them as well. So we really just want to get the information out there and help as many people as we can. And like I said, learn from our mistakes, because we've definitely made them.
Yes.
Right? And we continue to learn from people's mistakes because we have people in our group that are so much further ahead of us. So questions, comments, concerns, don't be shy. There are no dumb questions.
Or you can give your input.
I want to commend you guys on the information that you brought forth tonight. It was really good. It was valuable. Even though I'm part of the mastermind, I'm still learning every day. It is a lot of information, especially if you don't have experience with real estate. Like, everyone does have different levels. So I've owned my house for over 20 years, but I've never really had investment property. So it's all a brand new game for me, and I'm surrounded around the right people, and it's really good to join these webinars because there's always something that I can take away. So yeah, great information tonight. I'm proud of you ladies.
Thank you,
Thank you.
Wanda.
You're
I
welcome.
wanted to add to what Faya was saying about, being young or old or whatever, just get started, I was a realtor when I was 25 years old, and of course it was a different world 30 years ago when I was a realtor, and the interest rates were at 7%, maybe even up to 9, of course. And I just wish that I had done more and maybe saved more instead of buying, another car or whatever. You just don't realize that if you get started, that you are just going to grow that money so quickly. I had a condo when I was like 25 and I sold it. Whole other story, but I look back and now I'm just like, why didn't I just figure it out?
Yep.
Eat some more ramen and
I
just
know.
keep that, So they always say don't sell, but does anybody here have a rental property? If you want to volunteer, raise your hand, maybe even if you're not on camera.
Sold them, and I don't think I should have.
Nobody has rental property here?
Felicia does. Hi, Felicia.
Hi, Felicia.
Hello.
Okay, so do you have just a single family and you're thinking about multifamily or?
So I have two singles and I had a multifamily, but I sold it to buy my primary home. So looking into at some point getting back into getting another multifamily home once I get settled.
Did you find that you liked, I hope you don't mind if I ask you some
Mhm.
questions.
Sure.
Did you find that you liked, how many units was it?
It was two. It was a
Okay.
duplex, yeah.
Did you mind
Mhm.
managing that, or
Sure.
would you prefer to just have more passive income?
So I prefer passive. Same with I just I'm working a lot. I didn't have time to get a call in the middle of the night, so I then switched over to a property manager. And it took a little bit from my profit, but it was worth it in my opinion to just have them take care of everything. But I did enjoy the multifamily. I just at that time I had to. It was best for me to sell to gain my own property, our primary home.
Absolutely, yeah. Yeah. Well, there is all kinds of real estate. So, I have a short-term rental and I have a couple properties in Tennessee. I'm actually selling one of my properties to my tenant. It's costing me more with the property management than I anticipated. So I'm selling it to the tenant. And it's a single family, and that's the other reason too. I was like, okay, I'll just move that over. Oh, and Breanna brought up 1031s. So I don't know if anybody is familiar with the 1031 exchange. Yeah, Judy works at Title, so she knows. But if you sell something, of course, always ask your accountant. That's what we got to have our disclaimer, right? But if you sell something and you buy something like kind and it's in a certain amount of time and you identify it in a certain amount of time, then you don't really pay tax. You don't pay capital gains taxes on that. But with my property that I want to sell, I recently went to an all-day seminar and found out that I can't really 1031 that money into a syndication. And I may not even be able to JV with somebody. So I did talk to some other folks and found another way to 1031 that into some duplexes and triplexes in another state. So, we talk about networking. I went somewhere today for an hour and a half, and I met some phenomenal people. I was at something on Saturday, more phenomenal people. So, Judy, if you want to go with me to any of these things, I would be happy to take you. And, there's just so many opportunities out there. That's why we're holding these, because we want to get the word out that real estate is a great way to invest, not only in single family, but multifamily as well. And even, the big thing now is, oh, what is it called? Where you have all the rooms and
Like an Airbnb kind of situation.
not Airbnb,
Living.
Hostels?
co-living. Thank you. I was drawing
Co-living. Wow.
co-living. And there was a gentleman at my Saturday. And so I go on to say this too, because if you don't have funds to maybe invest in multifamily right now, which a lot of times it's only 25,000, but there's other ways to find funds. Like you could house hack, which means you rent out a room or two, or you turn it into another unit. My daughter moved out of the basement, and we have somebody who's moving in on April 1st to rent out our basement. And we don't have a separate entrance. The guy's a professional. He's going to be gone every weekend and he works all day. So we're just like, hey, but the co-living, there was a gentleman there. He's 28 years old and he has, I can't remember how many co-living things. I know he's making like $30,000 a month.
So co-living is something I've been looking into, and where they're really good is near airports, because flight attendants, they do a lot of co-living locations. So if you can get like near hubs like Atlanta, IAD, like the big hubs where the airlines kind of have their flight attendants, like that's their base, and they have their flight attendants sit there. They do a lot of co-living spaces there, and those are big and profitable in those areas. And I've known that a few groups of friends who didn't have 25 grand on their own, maybe this one had 10, this one had 5, they came together collectively to invest in something just to get started. And once they made profits and split the profit, they were able to move off on their own and do individual investments. So there are a lot of ways to get that done. And also we'll shoot out our information again if there are topics that you guys want to see on some of these webinars, because we do get guest speakers that are specialists in some areas, or sometimes they just have properties that they want to share and see if people are interested in. We're happy to divert from whatever it is that we planned on talking about that month and go into something that people want information on. So we're happy for you guys to let us know the things that you want to know, the things that you're looking for, and we'll do a webinar for that and try to get someone, if it's like a specialty kind of group. I know Cindy had someone who did self-directed IRAs, which I had no idea what it was, but it's a good way to use your money and be able to have access to your money out of like a 401k or a TSP, to be able to take it out and invest. So there are a lot of strategies, right? It'll be a whole different conversation that we're happy to have, but it's a lot of strategies that you can use. You'd be surprised where you have money that you don't know that you have money that you can use to invest. So
exactly. And the other two things I wanted to add to that is there's a lot of creative finance out there too in order to purchase properties. There's a thing called sub-2, which some people might not be familiar with. I thought Judy was going to add to that. And that's when you take over somebody's mortgage, and you're not really what's the word I'm looking for? You're not telling the bank. Don't say I said that. Unrecord. Yeah. But you do the deed. You do the deed at title, and you actually move the property into your name, but you don't take over. You do take over the mortgage in the sense of the payments. I'm trying to find the word I'm trying to find. But the point is, usually it's a lower entry. Like you can take, if somebody needs to get out of their property, they're going through divorce or whatever it is. Maybe you can get in for 10,000 or 20,000, then you take over a smaller mortgage, something like that. And then also, I do private money lending. Also, I help people lend out their money at a minimum of 12%. So if you had money and you wanted to lend it, I could help you do that, and then you could create a base for some funds to invest in multifamily. So just thought I'd throw those other couple things out there.
Got it. Cindy, are you referring to assumable mortgages?
No, not as not assumable.
Okay.
You don't assume them. Thank you, Lenny, for chiming in. You don't assume them. You just take over the payments.
Got it. Okay.
Via
On a
contract.
sub-2, yeah. On like, let's say I have this property where I have this 3% interest rate, right? Well, that looks great. My mortgage is, I think I said it was 13 something. It's a shame that the HOA is $500 a month, but let's just say that was a single family and I had this $1,300 payment, and that person could just take it over. And then you would go to title and you would do the deed. Judy, what kind of deed is that? Is it a special or a general warranty deed?
A general warranty deed.
Okay. Yeah. So there's a lot of that going out there, and there's just a lot of creative finance going on. So where there's a will, there's a way. And just find somebody in your community and just network. And that's how you can move on to some sort of investing that you feel like you're not able to do. So that's all I have.
Yeah, everybody's situation is different for sure. So you just have to find what, kind of like what Faya said, she has a goal. She's not leaving her 9 to 5. Cindy was like, I'm not working a 9 to 5.
I need
I'm
that
working
pension,
9.
honey.
Yeah. So we all have our own goals, like what we're trying to accomplish. So just trying to figure out what your goal is, one, is important, and then two, what strategy do you want to take? Because there's millions of strategies out there. Like, you heard all this stuff thrown at you. What do you want to concentrate on? So everybody's situations are different, their lives are different, their goals are different. You just have to figure out what works best for you and network with people and team up with people who are going to help you get to that goal.
Also, this is like, I still am trying to figure out what I want to be when I'm an adult. So although I'm like 100 doors in, there's a lot of places where I feel like I don't know what I'm doing. Like I just mentioned Todd and analyzing a property. If I find a property when I'm looking, right, and I look at it and I'm like, oh, this looks great, I'm calling Todd. I'm not going off of it looks great. I'm calling Todd, I'm calling Cindy, I'm calling Breanna. We're getting on a call, we're pulling up spreadsheets, we're running through the numbers. So it's not I don't know this, I don't know that, I can't get started, what am I going to do? There's still tons of stuff that I don't know or don't remember and have to look up in the process, but it can still work. And again, that's where the networking is really helpful, because there's absolutely no way I could do this on my own.
Yeah, they say you have to start before you know, right? You learn in the process. That's how you learn how to do anything. And we have a habit as human beings of overthinking and overanalyzing and
Hannah.
yes,
I
and
think
being
she's trying
impatient.
to, yeah.
I'm speaking from experience where I'm like, I need to know all this before, like, how, just because I'm further than some people, I'm not an expert. So why would people even look at me? Like, why would they look at me to help them? But that's so inaccurate. You learn as you go. I know a lot of things. I'm in the midst of it. Like I had mentioned, like there's some people way ahead of us or some people behind us. We're all on our own journey, and the only way to get started is to jump in. And thankfully, by being with this lovely group of people, they've helped me to do just that. They've helped me to get out of my head.
Excellent.
It's nice. Well, lots of great information. Thank you for the invite.
Thank you for
Thank
coming,
you.
Judy. We thank all of you, and reach out if you have questions, and you may get an email just asking you what you might want to hear on the next one. So if you get a chance to respond to that, that would be greatly appreciated.
And look out for episode 4, which will be next month. Thank you, Felicia. Yeah, episode 4 will be next month. So we're going to do these monthly. We'll always have different topics, guest speakers here and there again. So feel free to shoot us things that you want to talk about. We want it to be a conversation. We don't want it to be just us. So like, jump in, questions, comments. It really doesn't matter. We had one, I think maybe the last one, when we talked about setting goals, and someone had a goal, but they were like, oh, I don't want to talk about it because it's not real estate. And we're like, we don't care. right? Like just talk about it. We're working on setting goals. We're gonna help you get to your goal like we get to ours. So
Yes, and
join the
not to
conversation.
interrupt you, but from the last meeting, and we were talking about setting goals, and I believe someone gave this standard to do 5 things. Was it 5 things?
The power list.
Yes.
Like per day. Is that correct?
Yeah,
And,
we talked about that.
And so I did it for a little while, at least, almost a week. And honestly, it was really good. I mean, and I will get back to it, but I apologize. I'm kind of sick. I know you can hear it. And so that was really something that really helped me to like kind of get started in what I was doing. So that was really good information.
That's a good point. That falls right into it. Making the 5 power lists to get done every day. So I'm glad you brought that up.
Yeah,
Yes.
and we kind of message each other and go, did you do your power list today? And some of us don't answer. And some of us do say, I killed it today,
I'm winning a lot of days. I'm winning a lot of days.
Yeah.
Well, I'll be honest. I mean, I got started and I was doing well. I see one of my good friends are online. Her name is 𝗲𝗑𝗪, and I talked to her during the week, and I mentioned to her, I'm trying to do my 5 things.
Good.
So
I love it.
we'll see how that goes.
Yeah, no, that's great. You
win day by
inspire
day.
me. Yeah, that inspires me too. I remember I got to get back to my list.
Yes, it really helps. If you do the 5, well, let me stop. I didn't do it for the whole 3 weeks, but it really helped.
Yeah, Todd's the one who brought that up.
Oh, it was Todd.
So
Yeah,
he
that was
taught
very
us.
good.
Yeah, the one guy that's hanging around there hiding behind his name.
Right.
We just give him a hard time.
It's not even the
I
right
just
thing.
wanted to add that.
I know it's not the right spelling. It looks like Todd smelling.
No, willing. It's perfect for the 5 tasks. He's willing to do the 5.
Yeah, exactly.
The 5 daily tasks.
Yeah. There you go.
All right. Well, thank you everybody for joining. Hopefully we'll see you next month, and hopefully we'll hear from you guys about things that you want to talk about so we can incorporate them into our capital conversations.
All right, thank you.
Thank you.
Right, thank you.
Good night.
Thanks. Have a
Bye.
good
Guys,
one.
see ya.
All right. Bye.
Bye, guys.